Jim Gebhardt with the Gebhardt Group. 20 years ago, I became a licensed financial advisor. And I set out to do that because I wanted to help people with their answers around what do I do with my life savings. And here we are 20 years later. We're just a few days away from the election, the presidential election. And I've been talking with clients for the better part of a year, and I can't get over the amount of stress and anxiety that so many of us feel about the election. Interestingly enough, the stock market feels much the same way. We just completed our 9th day in a row of the S&P in red territory. And if you also look at the charts that reflect volatility has gone through the roof in the last few weeks as we build up to this election. So you've heard many of me say for the longest time that we've been in this artificially low interest rate environment since the big meltdown in 2008. And we've been hopeful, as I've said many times, I hope to wake up in the morning and the Fed has actually surprised us with an increase in the Federal Reserve rate. That doesn't seem to be happening. So what does that mean? That means that we can't have money market paying us anything, CDs, conventional bonds that we would traditionally buy. So we're forced to go into the stock market or into real estate or into commodities or some other place to try to get growth and yield on our portfolio. Yesterday I was at the gym and I bumped into one of my heroes in the business, frankly, John Good, who has been a portfolio manager for Smith Barney, for Lake Mason, and he's a large cap value manager. He's a buy and hold manager, meaning he doesn't really trade out of his positions too often. He sits on those positions for a long time. And we were just chit-chatting at the gym and talking about the markets, and he said, you know something, Jim, I've been at this a long time, and I've never seen it harder than this. I said, John, what do you mean by that? Tell me more. What do you mean by that? And he said, well, the fact that we have such low interest rates, it's artificially propping up the price of stocks. Stocks are very expensive. There are no good trends in the market, and it's just a bunch of hot money moving around from sector to sector trying to chase returns. You combine that with the fact that earnings are pretty lukewarm, and stock buybacks are also another way that companies are able to kind of artificially create earnings growth and get their stocks to go up. And he said, this is one of the hardest markets I've ever been a part of. John's about 72 or 3 years old. He's been managing money for about 40 years. And for a guy that's only been at it half as long as him, that really struck me. When it's this late in the cycle, and that's part of what this message is about, is to remind clients that we just finished the World Series, and to use a baseball analogy, if this is the 7th or the 8th or the 9th inning of the baseball game, we're not going to chase returns. We're not going to chase returns in equities. I would strongly advise you don't chase returns in real estate. And we're at all-time highs in real estate, both commercial and residential. We're about 5% off the all-time high in the stock market, and yet this volatility has been driving quite a few clients a little bit nutty. And if it drives you nutty, imagine what it does to Matthew and I at the helm. So just wanted to share a few perspectives on the market. We are always here to sit down, answer questions, see how this is affecting your overall financial plan, and please never hesitate to pick up the phone and give us a call so that we can help answer any questions you may have. Hope you have a marvelous weekend, and just think, next weekend the election will be over.